All right, ladies and gentlemen, welcome to Macro Ace with your host Tony. Going through non-farm payrolls today. Of course, the biggest release out of the month, and then of course we get the CPI in about a couple of weeks from the US. But non-farm payrolls have got about 30 minutes to the release, so let's get straight into it. So, first of all, what is non-farm payrolls? So this measures the net amount of jobs created in the prior month. Okay, now this is the reason why it's such a big release is because the data comes out the week after the prior month. So we get that data coming out pretty quickly from the US and the BLS, or the Bureau of Labor Statistics. So you have two surveys. You have the household survey, and then you have the establishment survey. So the household survey, what it does, it measures that's used to measure the unemployment rate. Then the establishment survey is used to measure the non-farm payrolls report. So that's one thing just to bear in mind, is that there are two different surveys that are put together into the non-farm payrolls report. The biggest one, or the most important one, is the establishment survey. That's surveying businesses on how many employees they have on their books, basically how many are part-time, full-time, how many people how many jobs have been lost or added. That's why it's quite important to have a look at. But we only get the net amount of jobs that have been added from that report altogether. But still, that's what non-farm payrolls is, the net amount of jobs being created in the prior month gone. Now, the other key thing to remember as well is how it affects the markets. So the key thing is with currencies, or for the dollar, whenever you get a very strong jobs report or much bigger than expected jobs report, that bodes well for the dollar. Of course, that means that interest rates could begin to rise, or maybe the Federal Reserve could pivot from maybe easing monetary policy or pausing monetary policy or rate hikes to actually starting their rate hikes. Of course, we're in a different scenario now where they've been hiking rates for quite a while. And as said, non-farm payrolls is going to be very key for the September meeting that we have coming up at the end of the month on September 27th. So for the currency, usually a better than expected report is good for the currency. Then if we're looking at stocks, this is where, hello everyone in the chat. Somebody said you're the British bloke on the mic. Yeah, I am the British bloke on the mic. What you gonna do about it? Anyways, but thanks for joining me. It's great to see you. So stocks. Now, within the tightening environment of what we're experiencing now, when the Federal Reserve is looking to raise rates off of a jobs data or data that is very strong or can have a very big effect on the economy, then they're going to be looking to if you have better than expected data, that can actually cause a depreciation or bearish reaction within the stock market for the stock indices. The reason being is that if you get much better than expected data, that feeds into the Federal Reserve's rhetoric or plan to raise rates higher or stronger and faster because of stronger jobs data. And then if we're looking at bonds, so bond prices within this tightening environment, this is also a very key thing as well. It's kind of similar in other areas as well. So with bonds, when you get a better than expected bit of data that comes out, bond prices will head lower and usually bond yields head higher. And the reason being is that because it's the expectation that the Federal Reserve is going to raise rates stronger or maybe go for a bigger rate hike. So bond yields will try and price that in as quick as they can. And that's why you see bond yields rising higher rather than going lower, and bond prices go lower. If you don't understand how bonds work, there is a little video that I did back a while ago about trading economic releases and how to trade economic events, talking about bonds and how that affects the market. So the key thing is with bonds, you have supply and demand. If you have a lot of people buying bonds, the government isn't going to hand out a high yield. They're going to lower that yield so they don't have to pay that much of interest back to those investors. So if you see bond prices going lower, the yield is going higher. Again, so two reasons. One, higher rate hike expectations, and two, the government is more confident in the economy enough to be able to pay out a bigger interest on that bond. So that's what we're kind of expecting today, and we'll go through in a bit more detail about what kind of reaction we're going to be seeing from non-farm. But that should kind of clarify there for you, for yourselves. Let me know if there isn't anything that I haven't clarified very well, and I'll go over it again. All right, so indicators weighing on sentiment. This is very key to understand where the economy is headed and which kind of direction non-farm payrolls might move in, or try and give you the best overall picture of what the US economy is doing now. Particularly within the employment area. So, and of course, CPI, that's very key too. So CPI declined to 8.5% from a prior of 9.1%, still at a 40-year high, but seeing that the inflationary pressure slightly easing for 1 month. Remember, that's 1 month bit of data, that's not a continuous amount of data. So CPI kind of declining a little bit in this month. PC price index year on year also saw a decline as well to 6.3% versus 6.8%. Core PC price index also saw a decline, 4.6% from 4.8%. You have the GDP second estimate data, which was better than the advanced report that we had of minus 0.9. We've got minus 0.6% compared to the first quarter of minus 1.6%. So a slightly better quarter than we had seen for the first quarter, better data from the US, but still in that negative territory, which some traders say that's a recession. Well, we've got to wait for other bits of data too, like jobs, housing data, to kind of crumble to say whether or not we're in recession. We're not kind of seeing that as of yet. People are probably preempting that. That's what we've seen in the stock market as well. In the stock market, the bond market, where the bond yields are, moving towards the downside a little bit, usually denotes that there could be economic turbulence on the way for the economy or ahead for the economy. So that's one thing to consider, is that even though we did get slightly better than expected Q2 data compared to Q1, traders are still thinking maybe that's, maybe we're in a recession, but that's a mixed better sentiment. Now, the unemployment rate, of course, was at 3.5% after staying for 4 months at 3.6%. So very solid, tough, tight labor market that we had. The ISM Manufacturing Employment Index, the data that we had this week, was it was better than expected at 54.2 versus a prior 49.9. Key thing is, if manufacturing sector is seeing strong employment growth and is above 50, usually that shows that we're in expansionary territory. Anything below 50 shows we're in contraction. So going from 49 to 54.2, kind of bodes well for the manufacturing sector. And whether or not that will feed into the non-farm payrolls report, or how strongly that will affect it, that's what we will see today. But again, 54.2 for the employment index and manufacturing. ISM data. Jobless claims that we had this week was at 232k versus prior of 243k. That's very tight, and I think a lot of people are kind of still keeping an eye on it. See if jobless claims ticks over, starts to heat up, but it's been very solid in that 200k range, 200k figure, 200 to 250k range sort of figure. So we're not seeing drastic numbers or drastic changes, leaving the release to be more of a non-event release itself for initial jobless claims. Then we have job openings data that we had, so 11.239 million versus 10.698 million. Remember, that shows you how many jobs were added and lost as well, right? How many people were laid off. So that's, although it's not as important as a non-farm payrolls report, still important to show that there are businesses that are adding more jobs to the labor market. They're looking to hire more people. So that was more of a positive figure for this week, and we'd seen a positive reaction from the dollar index. We had seen a negative reaction from the S&P 500. Not a very strong reaction, might I add, but nonetheless, there was a reaction to that better data that we had. Usually, we kind of say it's like a mid-importance release or an amber level release. If you've seen the FJ site, we have yellow, amber, and red. Red being the most important release, and amber being in the middle. Kind of, it can do something if it's really drastic, really big. But that's the key thing to remember there. So employment cost, what we had at the end of July, was at 1.3% versus prime 1.4%. Then triggers for the economic release. Then, so this is quite key. This will be. This is the honey. This is the honey money. I kid. So the triggers, according to economists, then. So the high estimate, they're looking for a high estimate of around 450k or 452k, with a low estimate of 75k. So did the numbers here very simple. They're looking for a deviation from the forecast figure compared to the actual figure of about 150k on the high end, and then on the low end about 227k. Again, this is according to economists on what they see the high and low end being. So they're expecting a lot of jobs being added. They're not expecting really that much of a job loss. And we'll go through some of the investment banks and their thoughts as well. But that's the high and low estimate for non-farm payrolls. Then if we go along, unemployment rate, economists are expecting, looking at a high range of 3.6% with a low of 3.4%. Average hourly earnings, very key for inflationary pressures as well. So that's something that we can't miss out. Although people don't really kind of focus on it, inflation is the big dog thing for the Federal Reserve at the moment. So we've got to keep an eye out on wage prices and see what they're doing. So if they do kind of spiral out of control or heat up, then that could add some further positive or bullish momentum to the dollar, or more of a we could see a stronger negative reaction from the S&P 500. But that's something just to consider, that we can't just leave out, the wage prices from the report. Then the private payrolls with a high estimate of 418k with a low of 4k. And looking at the investment bank views that we've got as well, this is quite key. This is what I kind of wanted to get to kind of show you. So JP Morgan, they're expecting non-farm payrolls to come in at 300k. That's the median estimate for today. It's 298k, but more or less in line with the median estimate for today. They're expecting the unemployment rate to tick down as well to 3.4% from 3.5%. TD, they're looking for non-farm to come in at 370k, so it's around a 72k deviation from the median estimate. And then the unemployment rate also tick down as well. Goldman Sachs are looking for 350k, with the unemployment rate to tick down as well to 3.4%. And then Nomura with the one of the other banks looking at 290k. So what was one thing that I was kind of keeping an eye on, and there was a post on Twitter of all the forecast of the investment banks. A lot of them were above 300k. And then you had some of the smaller banks compared to these bigger banks like JP Morgan, Goldman Sachs, or TD, that were looking above the 300k range. But there was a mix of data there from different groups of different investment bank companies. But that's just something that is very quite kind of key to see what these investment banks are trying to price in and where they expect the non-farm payrolls figure to come in at. Then the previous report, what we had seen, job growth was widespread, led by gains in leisure, hospitality, professional and business services, and healthcare. Both total non-farm employment and the unemployment rate returned to their February 2020 pre-pandemic levels. So everything is what they've said is everything has gone back to normal, right? They're not expecting, the economy is now fully functioning where it was. You're not experiencing any sort of downturn in the employment sector. And as I said, it was quite a hot bit of data that we had received last time. Is 500,000 jobs being added, with about a 300. If I just double check, there was about a 300k deviation just on the non-farm payrolls figure itself, which was my old deviation, kind of like trigger for the release. So again, that's quite key. Jobs have come back to pre-pandemic levels. The economy is kind of muttering along in a fine way. But that's something to consider from the prior report. Then the Fed and government views, right? This is also quite key where the Fed sees the employment of the labor market. Fed's semester. Key thing is that she did say that she'll focus on the inflation report rather than the jobs report. But that doesn't mean that every other Fed member is going to do that, or no other Fed member has kind of said that they're going to be solely focusing on the inflation report rather than the jobs report. But just something to be aware of. Fed's Mester, so she said that labor market will most likely weaken, and I think that's more or less correct. Is that with these super rate hikes that have been taken and provided, or lashed onto the economy, or put into the economy, that you're expecting some sort of a downturn in the employment area and manufacturing and productivity overall within the U.S. economy. So that's her comment there. Labor market will most likely weaken, again referring to the super rate hikes having an effect on the economy later down the line. Also she added that as said, she'll base her decision to raise rates in September on inflation data rather than the jobs report. Powell said there'll almost certainly be some easing of labor conditions, as well as some pain for households. Again, reiterating, if you raise rates quickly by a big amount, that's gonna happen, and it kind of needs to happen to dampen inflationary pressures. Remember, non-farm payrolls, can be very volatile month to month, but if you have more jobs being added to the economy, that means there are more people that can can get a job and that can spend money or spend more money within the economy, and that leads to prices going higher if there's a bigger demand for the same amount of goods that is being produced, or if there's not enough goods being produced to match demand within the economy, and you see prices go shoo to the moon. But that's what Fed's Powell sees, that there may be some easing of labor market conditions, as well as some pain for households. I.e., there might be less jobs that are added within the economy, and spending might drop off if that occurs, along with productivity. Cash Curry, adding inflation driven mostly by supply chains, the war in Ukraine, and again, that's what's causing, and also a lot of fiscal and monetary stimulus is causing wages to climb as well. Again, that's another key release we need to keep an eye out for, is the average earnings year on year, or the average earnings data. On the 30th of August, we had White House spokeswoman Jean Pierre saying the White House anticipates job growth to slow slightly. That's more or less been, I see that's factored into the median estimate that we have of 298K. Whether we get anything much lower than that, that's going to be, a telltale sign that maybe, the jobs, or the hot read that we had last time is more of a hot flash within the economy. So we'll see how long that kind of lasts, unless we do get higher than expected data, if it is higher than 300K. But if they're saying, okay, maybe it's slightly lower than 500K, okay, they haven't said that, then maybe we could get better than expected data, even though it might be smaller than the previous report. Investment bank views. So we've got about 12 minutes. Deutsche Bank, massively employment report will reinforce the case for 50 or 75 base point hike. That's according to their chief international strategist. So that if they see job growth strength, it could suggest the Fed can go 75 basis points and raise rates swiftly without jeopardizing growth. JP Morgan saying that the data for Friday, that they see it increasing by 300,000 to 400,000, the unemployment rate remaining unchanged, and the wage increase of around 4%. That's for the month-to-month data, by the way, which could tip the scale even further in favor of a 75 basis point hike. MUFG adding that there's been, as I said, the markets were trying to price in a Fed pivot for next year, of them to start cutting rates, and Powell pushed back against that, which didn't bode well for the stock indices. They started to go down because Powell said, we're still gonna hike rates. Who said we're gonna have a rate cut in 2023, guys? That's basically what he said, right? He basically said, shut up to the markets. But they see the policy rate going to 3.5 or to 3.75%. TD say that again, that the ramifications for Friday will make them tentative to forthcoming data, and that was according to their head trading strategist Sean Cruz. Then, so this is the prior report. So we've got 10 seconds before the release. doing it for time, guys. All right. So we're waiting for data. So you can already see this market started to kind of like move beforehand. And then boom, non-farm came out 528K, which is much higher than expected. It blew out estimations. As I said, there was about 300K deviation. You'd seen the dollar fly up in the air. That's the S&P there. And bear in mind, you also had the Canadian data too. So that was why I had the dollar cat there. So you'd seen, key thing is that when you had better than expected non-farm payrolls data, that the dollar will see an appreciation or has seen an appreciation in the past. Stock indexes within the tightening environment that we're currently in now see a negative reaction, as you see there. Gold had also, of course, if you're thinking about market correlations, when the dollar goes up, gold weakens. So again, people having more confidence in the economy as well. Don't forget, it's not just market correlation, but also what it means for the dollar. If you have a strong non-farm payrolls figure, if you have better than expected non-farm payrolls figure, and the economy is heating up quite strongly, and the economy is doing well, that means people are more confident in the dollar and confident in the US economy and don't need to put their money into a tangible asset like gold instead. So that's another reason, to kind of clarify why people trade gold as well, other than it being an inflation hedge as well. But there you go. So that was off a near 300K deviation just for the non-farm payrolls data, and we had also seen the unemployment rate tick down as well. So that was a very, very big reaction to the markets there. If I kind of skip forward, so you can see as I'm like kind of skipping forward, we can still see. Kind of go forward. So even after about 3 minutes, dollar's still going up. Keep going. Yeah, there we go. Basically just crushed it. Then you've also seen that futures are pricing, US futures were pricing in a 62% chance of a 75 basis point hike. So that is what you need to know. Of course, don't forget the bond market too. If I bring that up as well. Also for the bond market, of course, remember bond prices would have gone down and the bond yields would have gone up. And we'll look at the, if I bring up the previous deviations then for that release. So there we go. Just got my markets set. We've got about 8 minutes left. Here we go. Okay. So here's the, I'll just close that for now. So here is the deviations then for the release. So this is the nitty gritty, something that you guys, if you're a subscriber to the Macro Ace mailing list, you get to see this, with more time, take your time with it to really look at the data. But this is just showing you the deviation and what kind of, at what figure did the market react by this much or such and such, or this figure, how much reaction did it cause within the markets? So what we'd seen, so with a much better than expected data, we'd seen 139 ticks down on the S&P, 539 ticks down on the Nasdaq, on the Dow, we'd seen about 219 ticks down. Dollar yen had seen about 86.5 pips up off of the back of that data. So it's seen the biggest move. The reason why it's seen the biggest move is that currently in Japan, they're still easing monetary policy. They haven't considered raising rates at all. That's why we had seen the biggest reaction on the dollar yen in the last report that we had. So if they were to start raising interest rates, maybe that it might not be the leading currency pair to have the biggest reaction in the markets. But that's what happened last time. We had seen 86.5 pips up off of that much better than expected data. We're looking at gold had seen 105 ticks down, and then the bond prices is also quite key too. This is what traders have access to. They can trade from the 2-year to the 30-year bond, but the 2-year being the closest to the short-term rates and being the most affected by when the Fed raises interest rates or does anything with the rates. Then we'd seen a much bigger reaction compared to the 30-year bond. So the 2-year bond had seen about 51 ticks down. And then after about 10 minutes of trading, that's what the brackets represent. It was down by about 64 ticks. On the 30-year bond, we were down 37 ticks. And then after about 10 minutes of trading, the 30-year bond price was down 44 ticks. But the key thing is, so the 2-year bond price had seen the biggest reaction. The dollar yen has seen the biggest reaction. And also, of course, gold has seen a much bigger reaction too. But the key thing is, for if you're looking at the currency pairs, that's what you'll sort of expect. You could see a similar big reaction from the dollar yen, and you can see in the past too here. Not just for the last report, but also in July we'd seen the biggest reaction from the dollar yen, and then back to 3rd of June and so on and so on. Other than 6th of May. When the Eurozone or the ECB were kind of mulling whether to raise rates sooner rather than later. So that's what we had seen from the non-farm payrolls reports. We've got about 4 minutes left to the release. Not too long left. So let's do a quick advertisement. So financial juice, where you're looking at the data, where we're going to be looking for the data. So that's real-time voice and text service that investment banks have access to, which you can have access to as well, right? Why not take advantage of what investment banks do? Key thing is with a live voice and text service is that you want to investment banks use as a way to manage their trades or capitalize on potential trades. Try and take advantage of potential trades, and to jump in on that, volatility that they might see from a certain headline or economic release. So that's the key thing with voice news service. Of course, there are different ways to kind of use a voice to use a live service and trade it. But what we want to do is to on Financial Juice on the Pro version. We've got about 3 minutes left, by the way. And I will not forget. I will not lose my mind. But yeah, so you have, not only do you have your live voice feed here, you have your live news feed here as well with the headlines. Again here, key important headlines that could move the markets or could have detrimental effect to a certain asset or asset classes, or could be very positive or bullish. But if you do see big moves happening in the markets, but you don't know why, a live voice and text service will usually, will have the reason as to why that's happened. Remember, a lot of the markets are moved by news, fundamental news, and then it goes down to technicals, and then how the markets kind of take that in. But that's one key thing I think a lot of traders kind of put to the side, is that news does move the markets, and you've got to keep an eye on it. And that's what investment banks have access to. So that's why we want to provide you guys with a 7-day free trial of, let me put it here. There we go. 7-day free trial of Financial Juice Pro. So I'll pin that message to the top that you guys can have a little look at. 7-day free trial, try, see what kind of works for you, how you want to use the live voice service for yourself, what kind of makes sense. Hopefully you guys can still hear me. All right, not too long left then. We've got 1 minute left to the release. All right. I'm going to turn that off. Okay. So I think we're looking for, just for our deviations, we're looking for around 100, at least 100K. That's what we've seen in the last couple of releases, to see a bigger reaction from the markets. Down the head non-farm on the non-farm payrolls figure itself. Okay, 10 seconds. Starting to see the markets move beforehand. Okay. 315k, higher than the forecast of 298k. The unemployment rate ticking up 3.7%. That's higher than the expected 3.5%. Private payrolls 308k, higher than the forecast of 300k. Average work week hours 34.5, lower than the forecast of 34.6. Average earnings month on month, spot 3%, lower than the forecast of spot 4%. Manufacturing payrolls, 22k, higher than the forecast of 15k. Labor force, the average earnings year on year, 5.2%, ticking down to from the forecast of 5.3%. Okay, so markets, so the S&P taking that in a positive way. Key thing is that the unemployment rate was ticked up to 3.7%, and you didn't really see that much of a big deviation from non-farm payrolls on the headline figure. So you've seen a bit of a, although it was higher than the forecast of 298k, it didn't smash it. It didn't meet our 100k trigger there. Also, average earnings year on year also remain unchanged. We're looking at comparing it to the prior release, but this is a mixed, more of a more or less than positive data if you're looking at it overall, if we're considering deviation wise. Even though some of the data was higher than expected, it wasn't a blowout release. So if we're looking at the reactions then, dollar yen, let's have a look at you, see what you did. Okay, let's see what we got here. All right, what we got? So we have 57 pips towards the downside on the dollar yen. Okay, S&P. Let's see, what do we got? Let's see what the S&P did. So that had a nicer day. 89 ticks up. Let's look at the bond prices too. We will have a look at gold as well. Bond prices. Ooh, there's a whipsaw reaction. Whoops. There's about, bring it back down on 2 years, about 24 ticks up. Right, gold. Let's look at gold. All right. So key thing was we didn't see our 100k deviation for the non-farm payrolls figure, and the unemployment rate ticked up by 0.2%. Okay, let's have a look. And 113 ticks towards the upside on gold. Alrighty. Woo! Hot dog. Okay, so more of a mixed reaction on the dollar yen. S&P still going higher, slightly higher. Let's look at the NQ. See what we get. See what we got. Okay, NQ. Yeah, so you can kind of see that initial move down. If you kind of see that move towards the downside, probably just before the release, if I kind of look back at the video, or either it was on the release. But that's 368 ticks up. Look at the YM. Down here, see what we got. All right. That's there's 158 ticks towards the upside on the YM there. All right, so we've looked at the dollar yen. That's what we had said that had the biggest reaction last time. Let's look at the euro dollar, because of course that was the second. If I just double check, that was where we had the second large reaction to the non-farm payrolls figure itself. So if we take a look here, let's see what we get. Unless we get a bigger reaction compared to the dollar yen, but I'm not inclined to think so. Let's see what we've got here. Okay, there's about 26 and a half, about 26 and a half pips towards the upside. So dollar yen still has the biggest reaction out of everyone else so far. Key thing is, we had the data. It was better than expected for non-farm, but it wasn't great. It wasn't a blowout figure. It wasn't strong enough for the US to kind of say, or for it might not be strong enough for the Federal Reserve to say, hey, we know we're probably still looking for a 75. It depends. We've got CPI data now that we've got to wait on and see what happens. But I think that's now we're just waiting for CPI. If CPI comes in lower than expected, that could push the markets or the futures to try and use futures to try and price in a 50 base point hike. Instead, if you're talking about crude oil has gone up off of the back of release. So again, think about intermarket correlation. If the dollar goes down, crude oil prices head higher, and vice versa. Same with gold. So that's what we're seeing on crude oil as well. If I just bring it up. Could also get some prior revisions as well for non-farm. Okay, let's see what do we get here. There we go. There's about 55 ticks up, or 55 cents. Dollar yen, not having any fun. Okay, S&P. All right. So that is the release. That's all you kind of need to kind of take away. Let's. I'm going to kind of read through the comments here. I've got a load of people made some comments. I'm going to kind of go back. Oh, you guys love me too much. Right. Somebody said, "Will the Nasdaq sell off more than the S&P?" We had if you solely look at ticks, it was 373 ticks. S&P 89 ticks. Somebody said US 100 going to 9,000 today. Wonder. Somebody said the engineer said, was she hinting something? No. The market's the median estimate kind of priced in a lower than expected, a smaller report compared to the last report. Easy Job said, Tony, how do I subscribe? I'd like to have access to the Excel. Yep. So let me put that in for you guys in the chat as well. The mailing list, which you can sign up to. Let's bring it up here. Okay. Yeah. So here we go. Here is the link. Okay, so if you click on that link there, you can sign up to the MacRace mailing list where you can have access to the Excel sheet, and there's a PDF version that I provide to you guys for you to look at. And again, as said with Macro Ace, not only do I give you the lowdown of what to expect from the release itself, what is the current sentiment surrounding the markets. As said, if the markets are worried about economic data like non-farm payrolls and CPI, whether or not that's going to be enough for them to price in a 50 or 75, that's something to kind of consider and to jump on and listen to. And that could hopefully that helps you with your trading and your understanding of the releases too. It's a key thing. If you understand the release, then you kind of it kind of helps you better prepare yourself, I guess, is what you can say for the economic release. So that link is there in the chat. Don't forget, there is also a new product that we're relaunching again, or a relaunch of a product called Unusual Activity. So we have a beta-free test that we're doing at the moment of unusual activity. So if you like trading unusual volume activity in stocks, but also foreign in currencies and crypto as well, and in futures, we have that too. So you can join the free beta test group of the new service and have a little play with that as well. So that link has also been put in the chat as well for you. And then finally, of course, if you've liked this video and it's helped you with your trading or better understand what non-farm payrolls is and what to kind of expect, then don't forget to give it a like, share the video subscribe to the channel, make people more aware of who we are, of what we're doing here with Macro Race. Also, and then, if you like that, then if you like this stuff, give us a follow on Twitter as well. We've got the link there. So that is there in the link. Follow us on Twitter, get that going. Get the word out there that Macro Race is providing you, I hope, useful information with your for your trading. Let's see what else. Somebody said a combination with bank research would be perfect. What else? Oh, did you try and subscribe? Okay, well, I'll if you email me at tony@financialjuice.com, and then I can try and sort it out for you. I can double check what the issue may be for you. Dragon says unusual activities only for Windows. At the moment, yes, you can double check with Amar. Or I know it's for Windows at the moment. Have a little double check with him there. If you have his email address. But yes, all right. Real Idiot says thank you so much, Tony and Financial Juice. Well, that is non-farm payrolls. Let's see what bond prices are doing. They're mixed. Okay. Gold. Let's see if there's any difference on the 30-year bond price. I want to see if if there's more of a clear direction. I don't think we can get that if considering how in the release in the past, we've seen okay, yeah. So that's had more of that's had a nice mixed reaction. Usually the 30-year bond price has seen a smaller reaction compared to the 2-year bond price. But okay, so compared to the 2-year, 2 years more mixed. 30-year, yeah, it's all a mixed bag. So I think bond markets are trying to figure out. Wait a minute. Okay, jobs data was better than expected, but it wasn't a blowout figure. So do we price in a 75 or do we price in a 50? I think that's where the confusion is coming into the bond market there. It's quite obvious that you see bond prices you can see bond prices going down, with bond yields, of course, going higher in the expectation of a stronger rate hike. But it wasn't a straight shoot down like we had seen last time with the non-farm payrolls release. So that's one thing to consider too, is that bond markets are kind of mixed, whereas the S&P is ba-da-ba-ba-ba. I'm loving it. I'll probably get sued for that by McDonald's for saying that. Anyways, that concludes Macro Race. You guys have a lovely weekend. As I said, so Sunday with the mailing list, I send out one email every weekend on a Sunday detailing you or giving you a heads up of what to expect for the week ahead, and the deviations, of course, with the Excel spreadsheet, and then also the upcoming release videos as well. Next week, we've got the ECB, and we've also got the Bank of Canada too. So the Bank of Canada on Wednesday, the ECB on Thursday. Everyone's expecting them to raise rates as well. I think if I double check, a 75 basis point hike from the from the Bank of Canada, and the ECB a 50 basis point hike on both the deposit and main refinancing rate, the interest rate. So that's what we're going to have next week. We don't have CPO next week. That's going to be the week after. So, but if you do want to kind of wake up slightly early in the morning and join me for the ECB rate decision, actually that's a 8:15, so that will be in the US session. But yeah, if you kind of, if you're not on straight away for the US session from 8 a.m. Eastern time, and if you want to trade the ECB, that's more difficult to kind of, kind of work around what they're going to do. The ECB are known to, put out expectations for, for what to expect for the next rate decision before the rate decision happens. And, you have like sources saying that they could do this, they could, increase PEP. I'm going back in the past now. And also looking at the TPI, or the transmission protection mechanism, instrument that they've introduced to try and protect the Eurozone countries or other countries that are not doing so well with, less monetary easing and higher rates, to try and protect them from being damaged by a lot by the ECB raising interest rates quite quickly and by big amounts. So that's what we're expecting next week. Enjoy your weekend. Thank you very much. And I will see you next time. Sayonara, everyone.